Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Ken Van Leeuwen, founder and CEO of Van Leeuwen and Company, to discuss why preparing a budget and continuing to save is even more important in inflationary times. Ken, it's great to see you as always. Welcome back to Trade Talks.
You got it, Jill, and thank you for the invite back.
You got it. And how should one think about financial planning in an inflationary economy and choppy market?
Well, really the key is that don't stop saving because we're in an inflationary market. We realize everything's costing more. That's without a doubt. But make that savings budget like a fixed expense every month, like you make a car payment or you make a mortgage or a rent payment. Don't change that. Adjust everything else around that. And then, Jill, as far as investing in these times, right? Continue to save. Do not stop saving and investing in an investment program that you've set up with your advisor. You know, the future looks cloudy, but I just wouldn't stop. This is when we'll reap some big gains in the future, potentially.
And Ken, why is diversification key to navigating a changing economic landscape?
Diversification is always important because I think, you know, we don't really, I don't know what's going to happen at the end of this day, Jill, let alone what's going to happen in a year, 5 years, 10, right? So we always want to be prepared with different kind of investments, whether it's stocks, bonds, as far as stocks go, small cap, large cap, foreign, emerging markets. We just want to be in many sectors so we can get that potential. So when the market comes to us and the returns come to us, that we're there and we're not chasing returns, because that's really the key thing and what we're trying always to accomplish. Never chase a return.
Let's talk about the macro for a minute, because it seems to be everything is predicated on what's happening with the Fed and interest rates. What are your thoughts on the Fed orchestrating a soft landing?
Well, we're hoping they do it. You know, it appears that after, you know, last week's and the last couple of weeks' data is they still have more to do. You know, a lot of market forecasters were talking about a Fed pivot. We don't necessarily see that. We're seeing that they're going to continue to raise rates. I've even seen some people say that they're talking about raising rates again, another half a point in March from the 25 that they just did. I believe, you know, this is their goal. Their goal is to stamp out inflation. They did it in the early 80s, and I believe they'll do it again, but there may be some pain involved. So let's hope it's a soft landing for sure.
And let's take a look at asset classes. 2022 is an ugly year for bonds. What are your thoughts for 2023?
We actually like bonds right now. We like high quality corporates, longer term governments. Municipals are especially attractive because, especially if you buy a municipal bond with the state, you know, that you live in, you get the benefit of federal and state taxation elimination. You know, we especially like those. And because bonds normally, Jill, they perform well after, you know, after the last rate hike. So again, we don't know when that last rate hike is going to be. So we're starting to leg in with our clients into the bond market without a doubt.
And Ken, you also focus on high quality, consistent dividend paying stocks. What do you look for in those companies, and what sectors are most attractive?
Well, right now, the sectors that are most attractive, we think, are, we'll call them the material sectors, okay? Take a company like Snap-on Tools, right? Well, first of all, we look at a dividend paying stock that pays a nice dividend, but that also has the prospect to increase their dividend. Going back onto the previous point about Snap-on Tool, here's a tool company. We know them, right? We know their trucks. They drive around to various, you know, automotive shops. But what they're really doing is they're retooling for that next generation of electric cars. So people who work on electric cars are all going to need different tools. So that's why not only is it a good market to be in, but a potential growth market. Plus, they just raised their dividend, Jill, by 12%. So again, boards of directors don't raise dividends unless they feel they have good prospects for the future. We also like healthcare, even though healthcare stocks have pulled back. You know, healthcare is a long-term trend in this country. People are going to demand it, and they're usually very good dividend payers. So we like healthcare. We also like some retailers. I mean, you know, even after Walmart last week came out and they said, you know, they were a little bit cautious about the future. Sure, we're cautious, but we like companies like TJ Maxx that just had very good earnings. They were a little cautious again on their outlook, but they raised their dividend as well. So again, we're looking consistently for the future at companies that are increasing their dividends because they feel positive about the future by doing that.
All right, Ken, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.